Hi, this is Pete Krull, and we are back again with another episode of Dollars and Change, the expert's guide to sustainable and responsible investing. And we are in beautiful Chicago, Illinois at the USIF Sustainable Investment Forum Conference 2024. And I am with my friend Jon Hale, the former sustainability director at Morningstar. Jon, welcome to the podcast.
Thanks for having me.
Absolutely. It's when you agreed to do this, I was really excited because we've gone back and forth over the years. We've both been very big proponents of sustainable investing, and it's sort of an honor for me to have you on the podcast. So
yeah.
Thanks for doing it.
Thank you.
Let's start out a little bit with talking about your history. So I think you started out at Morningstar back in the 90s.
That's right, 1996.
Okay, and did you didn't start out in sustainable investing? It
No.
really didn't start back then.
It wasn't really a thing back then, but I did know about it. In fact, I had been in academics for a few years before I joined Morningstar, and I remember on the very first day that I was hired at the University of Oklahoma, and they were telling us all about like this, what do you do on your first day, right? And it was like, you have to go to this retirement session.
Right.
And thinking, it's my first day. Now we're talking about retirement. What even is that?
You're in your 20s. You're not thinking about that.
And they said, well, we have this 403B plan, and you've got here are your options. There are funds that you need to, designate where what you want to contribute to. And it just happened that one of the funds on the list was the TIAA Crafts Social Choice Equity Fund.
I didn't realize that had been around that long. Yeah.
Well, because this was early 90s.
Wow.
And, I sort of raised my hand. I was pretty bored of the whole session, but I raised my hand and said, what does this mean, social choice? And they sort of gave a brief explanation of, what that meant. At the time, I think they mentioned, while they exclude things like tobacco and alcohol and gambling and try to pay attention to good environmental performers.
Right.
That's my recollection anyway. So I thought, okay, well, I'll just do that.
Yeah.
And that was my kind of introduction to the whole concept.
Nice.
My very first day at work. Yeah.
And so what were you doing at Oklahoma?
I was teaching political science.
Okay.
Yeah.
And so that's what your background is
That's
in.
my doctorate in political science.
Excellent.
In Indiana, yeah.
Excellent. So so you get to Morningstar.
Yeah.
And what was your first role at Morningstar?
Well, Morningstar, we decided my wife had gotten a job in the Chicago area, and we were having difficulty finding academic jobs in the same place. So I was like, you know what, I could probably find a job.
Right.
Employable guy, I thought. And so literally, I just found this recently. Literally, on a Sunday, I was up visiting her because she was already in Chicago, and there was a little tiny ad in one ad in the Chicago Tribune, Sunday Tribune, that said financial analyst, and just 2 or 3 lines. It was tiny, and I had a big red circle around it, and it said financial analyst for an up and coming company that for a mutual fund analyst, and contact Morningstar at this number. I mean, tiny little ad, 4 lines. And so I thought, well, that's possible because it just so happened that a couple of weeks before that, back down in Oklahoma, one of my colleagues was running these like lunch and learn kind of things about 401ks and about mutual funds, because it was kind of the mutual fund craze back. I mean, it was 1991.
People were transitioning from individual stocks into understanding diversification. Yeah.
In the early 90s, everybody was doing mutual funds, and everybody was like, oh, what are these things exactly? So he was going to help his colleagues out and teach us about mutual funds. And he had all this Morningstar.
He's like, hey, I've heard of this before.
Well, no, I hadn't heard about it yet. But subsequently, though,
well, right when you circled it,
like, oh, that's what we just did the lunch and learn on. So okay, I'll apply. Literally a couple of months pass, and I come down. I drive all the way up for the summer from Oklahoma to Chicago. It's a long drive.
I can imagine.
And it was the Michael Jordan, Charles Barkley NBA Finals.
Okay.
And we were, into that. So I wanted to get back for that game. My wife had some friends over. We get back, we watch the game to halftime. And at halftime, she goes, "Oh yeah, I got a call today. I meant to tell you. I wrote it down. Morningstar wants you to come in for an interview on Tuesday."
That only took a few months.
So I'm like, okay, I guess I gotta figure out what Morningstar is and what they want So I ended up going to the interview, and they had us take writing tests and things like that, and didn't frankly really know all that much about investing even.
So I was like, my degree's in communication. Your degree's in political science. So we're both outsiders in this game. I think that's interesting. So is that what they saw in you, was sort of that analytical side from the Ph.D.?
I mean, yeah, I think so. I mean, I guess what they were doing at the time was, MBAs were a big deal at that point. MBAs were getting out and getting these big salaries and everything. And so the Morningstar wasn't, paying that much for people. And
Gotcha.
So they were like, let's go
let's diversify.
Route, and if we can get people with advanced degrees, even better. So yeah.
And so you started out as a mutual fund analyst. And how did that go?
Well, it was a pretty steep learning curve.
Yeah.
In some ways, it was not that hard to do, given what I had been doing in the past, and it was really a key part of Morningstar at the time. I mean, most of our business was analyzing mutual funds at that time and putting out every 2 weeks a little, newsprint type magazine almost format of just
like a tabloid almost.
Like a couple of dozen mutual fund, or more than that, maybe 60 or so mutual fund analysis, one pagers every 2 weeks. And so you had like a coverage list, and you had to do 10 of those every 2 weeks. It was quite a
churn. You were churning those out.
It was hard to do, and so that's what we did. That we're still doing. Also, though, you only had, for the analysis, you only had a small little 44-line space in the page. You couldn't go over.
So you had to be concise.
You couldn't go over, and we even had to still paste up the pages.
That's old school.
On publication day.
That's old school.
So you had to learn how to write really precisely. Every word had to count.
So how long were you doing sort of generalized analysis until you started to get into more, I don't know what we would call it, socially responsible investing at that time? Yeah.
Well, I noticed that we had, just a few, maybe a half a dozen SRI funds on our overall coverage list. And so I just volunteered to take them on my coverage list after a while.
Because you were interested in it, going back to sort of the Tia Kraft stuff? Yeah.
And in fact, I think one of them was the Tia Kraft Social Choice Equity Fund, and the Domini Social Equity Fund was on there at that time.
Maybe a Calvert or two?
Yeah, there's a couple of Calverts. That's about it. Citizens, which is
I remember Citizens,
anymore. It was there, in Pax World Balanced Fund.
Gotcha.
Was on it. And previously, we hadn't had any, and it was spread out among analysts, so there's no one with that expertise in it or a focus on it. So I thought, well, there's only 6 funds, let's just add them to my list, and I'll learn about them. And it wasn't too long after that I learned about SRI in the Rockies.
Okay.
Because all your funds are there. All these people from these funds will be there,
and you can see them in person and get to know them. Yeah.
So I went to an SRI in the Rockies. I think it was in Breckenridge, Colorado, and met all the
You met everybody you needed to know. Yeah. Because it was I mean, we're at this conference right now, and there's 333. I think somebody told me yesterday, and I think there was even more. I was at the newer version of SRI in the Rockies, ESG for Impact, last year, and there was more, I think even more people at that conference.
Yeah.
So we definitely have expanded. Considerably.
I think there was maybe 125 or something like that at that time.
Yeah.
And
So when did that start to get to really pick up steam? So I would assume that you went for several years with just having it as an aside, if you will, to your responsibilities.
Yeah. Well, I had gotten more and more interested in it after meeting the folks at SRI in the Rockies, and continued my coverage for a couple of years. And then in 1999, I got an offer to join Domini Social Investments, which at the time they had kind of the flagship fund.
Yes, they did.
SRI, because it mimicked the Domini Social Index, which it started back in 1990, so it was already almost 10 years old.
Right.
And had a lot of assets, and during the bull run and everything of the late 90s. And so I joined Domini for just a couple of years, but really focus on SRI.
Right. But you came back to Morningstar.
Yeah. A couple of years later, one of my former colleagues at Morningstar was starting a consulting, what he called a consulting group, and so he wanted. What we were doing basically is we were doing fund of funds for clients.
Okay.
So, especially variable insurance providers that had huge lists of funds that you could invest in.
Yeah.
And we were saying to them, well, you can use us, these expert fund analysts that we were. we can choose the funds and create aggressive, conservative models.
Yep.
And folks that buy income guarantees have to go into those models.
Mm-hmm.
Before that, they didn't. They could go anywhere. They could take the most risk possible.
Right.
And then because they knew they had income guarantees, so it was a big business for us for 5 or 6 years.
Excellent.
Doing that. So that was, no SRI, no ESG at that time.
But asset allocation and risk, understanding risk for those. Yeah.
Right. Asset allocation and putting together a fund of funds was really the focus. So we had a lot of big successful portfolios doing that. So that was all the way through 2008 or so. But a guy I knew, Joe Keefe. Who was the CEO of PAX until just recently he retired, and we talked about how this fund of funds idea could be an interesting idea in the SRI space.
Right.
No one's doing it, and so it could be ready-made portfolios. Really before all the financial advisors had their own models.
Absolutely.
Right? So,
yeah, I mean, because we're still doing fund of funds at this point for different risk allocations.
Right. So we had the idea for a couple of years, and it finally came to fruition in 2009 or 2009 to 10 era, called ESG Managers Portfolio.
Okay.
And we looked across the available ESG funds at the time, and ESG had started to become a term that people were starting to use, and put together fund of funds using different asset managers.
Mm-hmm. What were some of the metrics that you were using to really determine what went in and what didn't?
Well, we really wanted authenticity for one thing.
Yep.
But we also made a pretty conscious effort at the time to say, let's just recognize that as we look across this pretty small universe at the time, let's not require everyone to be doing the exact same thing. Let's acknowledge and then explain to our investors that, here's the approach that that the PAX funds takes. Here's the approach that I think we had a Parnassus fund in there Here's the approach.
So diversifying strategies, basically.
Yeah. Let's diversify our ESG approaches.
Yeah.
But all of them, had legit approaches.
Well,
as far as
and you said, at the beginning, one of the first things you looked at was, whether they, the authenticity of it, and everything you named, they've always been authentic firms. They're coming from the right place. They're not BlackRock, which is doing it as a marketing shtick.
Right. I mean, who knows? Maybe if we would have done this 10 years later, we might have been more tempting to put in
absolutely
BlackRock, ESG aware, and something like that.
Bite your tongue. That's my favorite fund to pick on.
We didn't have any funds where people were going, "What is that? What do you have that in there for?"
Exactly. That's good. So you were in the consulting group doing this. At what point did you go sort of full time on the SRI analytical side?
Let's go forward, several more years, and it's around it's 2015.
Okay.
And by this time, you're really starting to follow and see that this field is starting to really grow.
Yep.
Particularly around ESG and now ESG analysis and ratings and things like that.
More of a quantitative aspect.
Yeah, and a few more funds were being launched, and I literally just thought. Well, first of all, I thought getting to probably to the final third or so of my career. And I think I want to work in ESG, get back to really focusing on that full time. And so I was actually, frankly, I was actually looking for jobs in ESG space. And I thought, I've been at Morningstar a long time. I've talked to our CEO, Joe Mansueto at the time. He was the founder of Morningstar. I've talked to him about ESG before. I think before I, just take off and do something else, I should just ask about it. I should just try to push this.
Pitch it. Yeah.
So, and this, that, makes it sound like I've struggled over this, for weeks and months. But no, it was literally one afternoon when I really wasn't too busy at work and thinking, I'm just going to write an email to Joe. So I write an email to Joe, and something like, ESG is a big thing. Morningstar's mission has always been, ESG is getting to be a bigger thing. Morningstar's mission has always been, we want to help investors make better decisions.
Right.
We want to provide them with the kind of information they need to make decisions. And I just made that pitch that, look, it's becoming more and more interesting to people. There's more demand, and yet there's not really anything out there that helps people. We don't do anything really having to do with ESG except cover a few funds.
Right.
And so, I thought, as a busy CEO, it'll take a while to get any kind of response to that. And bing,
right back.
20 minutes later. So I'm like, oh no.
Come to my office.
Joe's emailed me. And he's like, yeah, sure, let's do it. Let's look into it.
Wow.
And he connected me with a colleague. We had an international practice, offices and so forth back then, but they weren't. They weren't that visible to us in some ways in the U.S.
You weren't really coordinating with them.
Yeah. And he said, there's a guy in Amsterdam that's been kind of in my ear about this too. So why don't you two get together and figure something out?
And you did.
That was all. And the fund rating, the Globe ratings that ended up coming out of that was because I was talking to someone about a job as his ESG analyst, and he's looking at me and saying, we're shifting. This was someone that managed like $20 billion in a pensions. We're shifting from traditional SRI to ESG. Well, that's what we've told all of our managers to do. But I can't really tell what they're doing. They say they're doing it, but, and he kind of looks at me, there's kind of a pregnant pause there, like somebody like Morningstar, I'm finishing the sentence in my mind thinking, oh yeah, somebody like Morningstar could access ESG data and apply it to mutual fund portfolios, which we have every portfolio of every fund in the world, basically. And voila, we have, an assessment of, a sustainability assessment based on an ESG score for every fund.
And that's ultimately what
we ended up doing. And, having the email from Joe was all I needed to go around the company and get the resources. And it turns out, everybody's interested in sustainability. And so everybody was, there's so many people that wanted to be part of the project. It was amazing.
And I think ultimately that people who are analysts really understand the value in ESG. Politicians at this point in time are like, it's woke or whatever. But people who actually understand what analysis is about and who are fiduciaries and who recognize that, it doesn't matter whether you've got a manufacturing facility in Florida on the coast or something in Northern California that's had fires come through. These are material issues. And so I think analysts are a lot more aware than most people are of how important this is.
Yeah, no, I think that's right.
So I'm going to transition a little bit here. Let's talk about sort of, you started to get into it a little bit, but let's talk about sort of the arc of the industry. When I started, it was socially responsible investing, and it was basically three things. It was inclusion and exclusion, it was shareholder advocacy, and it was community investing. Those were sort of the three pillars of it. And it's really evolved over that time. Talk to, a little bit about what your vision or what you've seen over the past, 30 years or so, or 25 years.
Yeah, well, the original version, I think, was always also interested in environmental issues, but the data wasn't there to really make very detailed assessments on that basis. So, the collection of ESG data, I think, it really gave folks in the field the ability to assess environmental performance in a way that they hadn't been able to before. And so that was a big, I think, leap forward. And then I think just you kind of fast forward, we had the original report from 2004, which is exactly 20 years ago, that coined the term ESG. It came out of a UN-sponsored conference,
right?
And it basically made this very direct appeal or claim that said, listen, there are these other factors that typically are not taken into account by analysts that could have a clear influence on company valuation. And so these kind of intangible factors that are environmental or social or governance, like bing, 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 ESG.
And now we got numbers.
And meanwhile, I think the other thing is that, it's the age of the internet, all of a sudden you had all this data out there that was available. Now it's not all perfect data, right?
No.
It's like companies weren't necessarily, providing all the data themselves, but there was a lot of data out there to be gathered.
Right.
The ability to gather it was improving, and so we had this sort of avalanche of ESG data out there that you could start to use. So the field became more. At least the attempt was to be more systematic about assessing ESG factors
and more standardized, right? I mean, we still don't have some standardized, but absolutely.
And so those were big changes. And with SASB coming along in around 2010 or so,
right.
I think really focused attention on materiality and this idea of you can think up a list of, dozens of ESG factors, but they're not necessarily going to be material for every single industry or single company.
Right.
But there are going to be some, and so let's start focusing on what that subset of ESG issues are, industry by industry, company by company, that are material. Therefore, that we can really make that link
Right.
to financial materiality with these CSG issues.
So I want to talk a little bit about shareholder advocacy, and I've long been a proponent. Shareholder advocacy is good in certain industries because I think you can actually have a legitimate opportunity to change, and there's other industries that they're not going to change. They're just that's what their business model is. Talk to me a little bit about sort of your evolution over time on that, especially when it comes to things like fossil fuels.
I've always thought that shareholder engagement resonates with our investors.
Right.
It's always resonated with me. I thought it was amazing.
Absolutely.
First learned that this was an element of what
Right.
what SRI does and what sustainable investments continue to do. It really speaks to people, and I think it's very important. I think it's also something we've underplayed a lot.
Absolutely.
Over the years. It has changed. I think back in the day, let's just say the 20th century, it was fairly adversarial. I think companies would get, you would attempt to engage with a company, you'd get, a lot of stonewall.
How dare you?
And some, intense types of conversations. But, over time, and certainly running up to today, many companies are, I don't know if I would say completely happy to have engagements with investors, pushing them on the institutions. But I think they recognize it as something that's,
It's the reality. It's the reality of the current paradigm.
And it can help them better understand some of these issues.
Right.
And they're, from what I can tell, they're more eager to engage on the whole,
Right.
Than they used to be. I think that one exception could be with fossil fuel companies.
Yeah, you talked about this in your speech the other day.
It raises the question. I was saying in my talk this week that, within the industry, it appears that the majority opinion, at least of asset managers, and as more large non-ESG focused asset managers have gotten into the field and have funds and so forth, that the view is we should engage with rather than divest from fossil fuels. And, I guess on that score, I just question how effective that's been in this particular case. Fossil fuels, we're asking companies essentially to change their business model and say, how are we going to do this? How are you planning on becoming a different company?
From top to bottom. I mean, that's their product in many ways is the cause of our existential crisis at this point.
And their product is the cause of their existential crisis.
Exactly.
But they're like, so you're coming in there kind of asking them like, you're gonna die, you're gonna kill us all.
Evolve or die.
But what are you gonna do? What's your plan? And so I think, obviously if you're a big asset manager and it's a major engagement with a large company that you own lots of shares of, you can make some significant headway.
Right.
But I see it kind of on the other side of things, like what does our investor base think, and what does our investor base want? I think most people who are sustainable investors, if they look into what it's all about and kind of what they want out of it, it's not going to be very long until they think, oh, great, this is going to be a way I can get out of fossil fuels, right? And yet,
Yeah.
how many ESG funds are truly fossil fuel free by policy? Not
That many.
Not that many.
And that's such a contrary to ultimately what I think retail investors want.
Right.
Retail investors, while they may understand shareholder advocacy and the importance in general, they also, for the most part, want solutions. They want to see that they're investing in the solutions, and so few funds at this point are truly focused on solutions that can also be a core holding. That's part of the problem is you can get solutions, but it's going to be in a niche fund.
Yeah.
Can you find one that is both a core holding and solutions provider?
Yeah. Well, and that's why, I'm advocating for funds, ESG funds, sustainable funds that currently invest in fossil fuels to say, look, we're going to wind down over the next 5 years or so. Let's tell our investors we're going to be fossil fuel free. We don't want to do it tomorrow. We're going to do it within the next 5 years. But also, here's our plan. Here's our strategy for how we're going to build up exposure to renewables, to climate solutions, recognizing that there's not so many of them out there in public markets that you can create a huge position in them necessarily. There are some thematic funds out there that are doing that.
Yeah.
But if you're a broad, diversified fund, I don't even really know what the appropriate allocation sort of should be based on market cap because because renewables and climate solutions don't.
It's mostly mid cap. They mostly fall in the mid cap.
Yeah.
And I think that's where we've run into a lot of issues with the solutions based versus more of the sort of generalized ESG approach.
Yeah.
Is that we're so index driven at this point, and you can't index really where we're going by looking in the rearview mirror where we've been. And we really are transitioning this economy. And so, we run into issues like tracking error. We run into issues about sector allocations relative to an index. And I would argue that we probably need to take a look going forward at not looking at tracking error and not looking at, what's the sector allocation in the S&P and how what's our variance from that?
Yeah. Yeah, no, I agree.
It makes sense to me. So I want to keep our listeners' time in mind here. Briefly, where do you see the industry going?
Well, Peter, I think that the one thing that I see out there is continued demand, or at least continued strong interest in sustainable investing. But I worry that if our funds, because that's the basic product we're offering to people as who are interested in sustainable investing, if our funds don't, really, I think, try to connect better with those investors.
Absolutely.
That they're going to say, what's the point?
Right. Tell story. That's one of the things that like what we're doing right now for me is really important. Telling stories about why sustainability is important. What are the potential impacts that you can make, and how it's fundamentally different than something that you're going to see, off the shelf from any of the big providers.
Yeah,
absolutely.
Yeah.
So everybody gets the same last question, and so you're about to experience it. So we see a lot of impacts of climate change hitting, from more intense storms to wildfires and droughts and things like this. In light of everything that's really happening right now, how do you maintain hope?
Well, in light of the fact that we have an election this year.
Absolutely.
I think ultimately it's kind of interesting when you think about it this way that when we have like these extreme weather events and things like that, people are around you, we're all experiencing it. It's not like some people are and some people aren't.
Right.
So at some point, I think there's going to become a more of a, if not consensus, then at least more widespread agreement that this is a problem. We need to really start doing something about it. And gradually that it will come around to at least, mitigate the worst effects in time. There's still time.
Yeah.
And so it's hard sometimes.
Understood.
With our politics today and everything else, it's kind of hard to maintain optimism. But, I think it's important. And I think that's why it's important for people to invest this way if it's something that's important to them too.
Right.
Sustainable minded. Do the things you can do to make a difference.
Yep. Absolutely. Jon Hale, thank you so much for joining me. And thank you for joining us as well. I want to remind everybody to please make sure and like this episode. And also, if you're not following us on YouTube and on your other social media channels, that you do so. We'll see you next time. Thanks again.